Welcome to the BankTalk podcast, the show where we talk to leaders and experts from the community banking sector. Whether you are a current CEO or aspire to be one, this podcast will give you valuable insights and advice on how to run your financial institution better. Each episode features a different topic and a guest who shares their experience and knowledge with us. Tune in and learn something new with BankTalk podcast.
Hi, and welcome to Bank Talk. I'm Charlie Kelly, your host and partner at Remedy Consulting. Today, we're talking alternative sources of funding for your commercial customers. And the concept behind this podcast is going to be, what if you're a small business and, as rates rise, credit scores change, et cetera, you can't get a traditional bank loan? Well, there are plenty of fintechs out there that are coming up with alternative solutions to try to support that group of customers. And I thought, if you're running a credit union or a community credit union or bank, it might be important for you to hear what's out there, if they can't get a traditional small business loan or just a traditional bank loan. So without further ado, we've got Alex Schwartz from FundKite. Alex is going to be kind of walking us through what they do for a living and maybe some of the peripherals around that. So let's get to Bank Talk. Okay, welcome back to Bank Talk. Today I have with me Alex Schwartz from FundKite, CEO of FundKite. Alex, thanks for joining me.
Thank you. Good morning.
So, Alex, we spent quite a bit of prep time talking about just what FundKite does for a living. And where I find it fascinating is, I think, since the Bank Talk podcast is focused on banks and credit unions around community banks and credit unions, I think a lot of CEOs in these operations always are intrigued by where their clients go get funding outside of the banking industry. And I thought some of the things that we talked about FundKite's model, fascinate me. So if you're good with it, could you start out with maybe the difference between what I would think of as a traditional small bank loan versus the funding model that FundKite has?
Sure. So let's define what a loan is. A loan is a fixed amount of money for a fixed time period with a fixed payment and an interest rate, right? You have to repay it in fixed payments and you have to repay it by a certain date. And usually there is a personal guarantee attached to it. So if you default on a loan, the lender has the option to go after you personally, okay? Our product is revenue-based financing. So we're purchasing your future receivables at a discount for a lump sum payment today. And we're going to collect those receivables based on your sales. So, for example, let's say we give you $100,000 for $120,000 of your future receivables. And we're going to collect that $120,000 at a 10% rate, meaning that 10% of your sales you're going to remit back to us until we collect $120,000. So if your sales fluctuate, so for example, you did $1,000 in sales today, our repayment remittance would be $100. If your sales drop tomorrow to $300, the repayment would be $30. So we take the ride with the merchant, no fixed payment. The repayments fluctuate based on your sales, and there is no term. Certainly, if the capital you get from us doubles your business, we're going to collect our money faster. But if you experience a slowdown, if your business is shut down, you had an issue, you had a water leak, you have no sales, we're not collecting any payments. That's the risk we take. If you go out of business, that's the risk we take. What we do require is, we call it a personal guarantee of performance. And what that means is that you are not going to divert those sales, meaning that you're going, when you make sales and you collect receivables, you're going to pass the portion through to us. That's the recourse we have. But if your business fails, you got a business, hurricane, earthquake, God forbid, you just failed. That's the risk we take, and we take the ride with the merchant.
When we prep for this, I asked a question about factoring. Not really understanding the industry all that well.
Sure.
And you corrected me and you said, this is not factoring. And you explained the difference. Would you
Sure.
mind walking the audience through that real quick?
Yeah, of course. So typical factoring is I'm a manufacturer of widgets, and I've got $1 million order from, let's say, Home Depot, right? They want to buy my widgets. It's going to cost me $500,000 to make those widgets. I don't have $500,000. I take the $1 million invoice from Home Depot. I go to a factoring company and I say, I need you to advance me $500,000 against that $1 million order so I can make those widgets and deliver them to Home Depot. The factor gives you $500,000 and there's agreements where Home Depot, when they're ready to pay for those widgets, they're going to make those payments to the factor. That's a factoring. You have a concrete order from a purchaser, which usually has to be a very credible purchaser to get factoring. In revenue-based finance, there are no sales yet. So let's, for example, take a fast food chain. An operator's got 12 fast food restaurants, right? And he wants to expand and open a 13th one, right? But he's not bankable. So we look at past sales and we say, okay, this guy generates revenue. He's selling burgers, soda, and everything. And based on those numbers, we're going to provide the funding. But tomorrow, for some reason, he stops selling burgers, right? We don't know if he's going to continue selling. We anticipate, and our underwriting tells us that this is a good merchant to fund, but the risk is unknown. He could be shut down because the roads are blocked on the street. There's a flood, and that's the risk. So that's the biggest difference. Factoring, you know who the purchaser is, you know the amount of money, and you're advancing money against that purchase order. We're advancing money against anticipated sales, but those sales aren't there yet.
Okay.
We don't know who the customer is yet, if that makes sense.
No, that's great. That's great. Because I think when talk about a bank or a credit union from the perspective of, let's just take an SBA loan. There's a set of criteria there that says A, B, C, and D. And for a lot of small businesses, they can't apply for that because they don't hit A, B, C, and D. They do not hit those criteria.
Right.
I would imagine that the merchants that you're funding have already maybe taken a look at going out and getting a personal loan based on Charlie's credit score, history, right? It's probably going to be the owner's credit score and history, I would imagine, right?
Yep.
And that doesn't fit into their model. They've got a business that's running, but for some reason that doesn't fit.
Yeah,
Generally, the folks that are coming to
let's try to think about the natural progression of people who need money, right? For business purpose. They probably go online and business loan. So they're going to see all these ads, banks or non-banks or all these advertisers. They're going to start applying. The banks have very strict criteria and banks are very credit score driven, right? These are all algorithms that have been around for 50, 60 years. Nobody looks at this stuff. So they're going to apply, they're going to get denied. Then a lot of people know about the SBA, and certainly SBA has certain requirements. Again, a lot of times it's credit score driven and time in business and revenue, but credit score plays a major, major role in all of those products. Mm-hmm. They get declined, right? Where do they turn to now? They either turn to high interest rate credit cards or they turn to friends and family, and that's not always easy. Maybe friends and family, they have problems. And that's also not easy to do, to ask your family, hey, I need money. I want to grow my business. It takes a lot to do that for most people. So we actually work with a lot of SBA lenders that send us their turndowns. Merchant applied, couldn't get funding. They refer them to us, and we're able to solve the issues for a lot of these merchants.
No, that's a great answer. I think that answers what I was looking for. So then next place my head naturally goes is to, you mentioned underwriting criteria. And I think if I would ask around to some of my bank CEO friends, their loans are all about the underwriting criteria. So can you just give me a better understanding of when a merchant approaches, what is that, just give me the 4 or 5 things you think are the highest priority when it comes to underwriting.
And it's important to understand the difference. Most banks are algorithm. That's why they give you a decision in 30 seconds. We Actually look at the bank statements, cash flow, operations of the business. That is key to us. And that, while we do have a lot of technology that does that, it does require a human eye. No two businesses are the same. Two Burger Kings, one owner manages it one way, another owner manages it a different way, two different markets, two different sets of expenses, cost of labor, and all of that. So we have to have a human who takes a look at every submission on the cash flow side. Primary to us is the next five things. Time in business. We do fund businesses that are at least 6 months in business or longer. Number two, industries. We look at certain industries because they are affected by the tightening, interest rate tightening, economy, and other factors. So certain industries might be more riskier for us than others. We will look at background, and we will look at credit. We don't really care about the FICO score like the banks do. We care about how they got there. So certainly if someone is really late on all of their payments and their FICO score is low and they're in foreclosure, that's a higher risk merchant. That's going to be an issue. But if somebody has a 550 FICO score because they're utilizing 90% of their credit, but they're making timely payments, they've never been late, that's not a decline for us. We understand that. We understand the small business. We understand the entrepreneurs. And they typically use a lot of their available credit. That's how they function. So we understand the mindset of an entrepreneur, where the banks only understand what the algorithm kicks back.
We'll be right back.
If you're dealing with a technology vendor, consider giving Remedy Consulting a call. At Remedy, we're dedicated to helping our clients get the most out of their tech spend. If you're considering changing one of your major tech providers or are renewing a contract with a vendor, the Remedy team may be able to add some value. Our clients enjoy our deep experience working inside these major vendors, and that background helps us ask questions which eliminate headaches and expense for our clients. Sometimes that's immediate relief, in the way of your vendor invoices, and sometimes that comes in the form of contract language protection for a strategic move that you may want to make several years later. The group of experts at Remedy have years of experience in core systems, digital, mobile, payments, item capture, commercial banking, pretty much the whole gamut of technology for financial institutions. Remedy approaches the BankTalk podcast the same way we approach our client engagements. We always try to fill some knowledge gaps, but also just have enough life experience stories to remain entertaining. So if you're renewing a technology contract or you have projects going on, just need another opinion or a project manager from outside your organization, reach out to us at remedyconsult.net. Thank you, and we appreciate you downloading the BankTalk podcast. Now let's get back to our episode. Gotcha. Let me give you a scenario, and you tell me if this is accurate. But if you had a small business owner who paid off his mortgage and uses credit cards and other things for debt on the company, that would be paid off, right? All the personal debt. Because that person's debt is only credit card, they might have a terribly low credit score.
Sure.
I mean, and oddly be very bankable in some scenarios, right? I mean, maybe they're selling cash, maybe they're, like to your point, maybe the future
cash,
sales or receivable, something could be value there that is just not seen at all by the credit score. Is that a fair, or did I overshoot that?
Very, very fair. Very fair. So there was a time when we'd walk down the street and your banker knew you. And, you'd have coffee together. Good morning. And how's the kids and everything. So the bankers understood their clients. Today, there's a big gap. Now, look, the $100 million plus companies, they do have better relationships. But you'd be surprised how many $30, $50 million companies we see that don't have good bank relationships. They sometimes don't even know who their banker is. So you got to eliminate just looking at what the data, the credit score data tells you. You've got to look deeper. And, we've got this down to a science. You can underwrite a file in 10, 15 minutes and provide $2 million funding. So but it does require a human eye, and you have to think a little bit about outside the box. You have to understand the entrepreneur. You have to understand who you're dealing with and the struggles and challenges. Look, we're not anti-bank. We're actually a very good solution. And we work with a lot of bankers who want to help their customers when they can't. We use this tagline, when banks say no, we say yes. But we're not competing with banks. We're a product that helps the unbankable. And we have a lot of referrals. Bankers refer merchants to us that only because of credit criteria or time in business, they're unable to help them, and we can.
Right.
Look, our industry is rather large. In the last 10 years, it grew 20,000%. There's major players in the industry that are filling this void.
Gotcha. Well, so how big is the average loan? Could you give me a feel
No,
for
we don't do loans. Remember, our average size is approximately $110,000 right now.
Okay. And client size or sales, or like how do you classify
so
average?
let's just say about gross sales. Average client's about $3 million a year. We've funded some smaller businesses as low as $500,000 a year in sales.
Okay.
And some businesses that do $50 million a year in sales.
Gotcha. Yeah. I'm sure the small ones drag the average down, right?
Yeah, but we typically tend to fund larger size deals, but of course the smaller ones do drag the average down. That's correct.
So then let's talk about the back end of this, which is, so do you hold the revenue purchase agreements? Do you have a funding source behind it? Do you how do you keep this thing capitalized?
So this has become a really interesting industry for a lot of high net worth individuals, hedge funds. And so we do a lot on balance sheet, and we do have investors that take down portions of these fundings.
So they take the risk.
It does generate higher. Look, there's certainly risk associated because there are defaults, but we've performed pretty well. And yeah, so it's very popular. In an average week, I'll get 30 high net worth individuals or hedge funds or institutions that call me to inquire about participating with us.
So they act as a participation.
The
backside of it's a participation type of an arrangement.
Yep.
Okay. I think I only have one question left. Can we talk about defaults? Are you comfortable talking about default rates, or how you think about that in your industry?
Yeah. So our trailing write-off rate is about 6.8%.
Yep.
And that tends to be the real businesses that fail, right?
Yep, gotcha.
Most of it is like real businesses that just fail, and we write it off. But where we see the defaults, interestingly enough, and I'm probably sure that the banks have the same problem and or other lenders or financials, is just people wake up one day and they just don't want to pay you. I mean, it's pretty wild. So 3 things happen. One, and that's something none of us can underwrite, right? You can have somebody with a 750 FICO score, great credit, great everything, and 3 months from now, he wakes up and he just says, screw you, right? Yeah. I'm sure that happens to everyone.
Sure.
So that's one type of a default. The second, and this is, I think, a big issue, not just for us, but for banks, is the debt settlement companies. Debt settlement companies, and the third is the debt settlement lawyer. Yep. They go out and they market, and they, go to these people and say, hey, don't pay Funkai, don't pay, BOA or anyone. We're going to settle your debt for less. Stop paying. We'll settle at 40 cents on the dollar.
Yep.
Kind of the same as number one, right?
Sure.
So with us, that seems to be a bigger problem. These misleading debt settlement companies. And certainly we have recourse and we go after that. Look, when a merchant has a problem with us, right? Meaning because we're reconciling their sales and debiting our remittance, our payments based on those sales. But if a merchant has a problem, we're very merchant friendly. We work with merchants. But, when a merchant blocks their payments, doesn't answer the phone, and divert sales, what else can you do? You do have to take legal action, and we are protected in that sense. But again, I'd say 9 out of 10 defaults are probably those guys that don't want to pay, or they get the debt settlement company that promises them Oh, don't pay them. I'll settle 10 cents on it. I'm sure that's happening. Look, banks have a lot of credit card debt that gets written off for this reason, right?
Right. Yeah. And that's how they advertise, right? I mean, that's
Yeah.
how that settlement lawyers are advertising.
Terrible, 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 terrible. And almost all the time when it comes to litigation, because we're merchant friendly. And that's the problem. And then again, look, yeah, I'm just going to say there. So the defaults are more because of people just waking up one morning or being promised something that's not true.
And those are, that doesn't sound like a terrible rate. How about if the economy changes? How do you think about, just give me your philosophy on an economy change. Is it good or bad for you? Because, good might be interest rates are climbing and there's all kinds of things going on that push.
Really, really good question. So I founded the company in 2015. And so what are we on? Our almost 9 years now. We've seen it all, right? We've seen great economy. We've seen lockdowns. I really have seen it all. Interest rates really low, interest rates really high. Overall, certain industries are affected by the tightening. So anybody associated with real estate is having a hard time. Inflation has affected a lot of merchants across the company that are, selling goods, supermarkets, and anybody, because they don't know how to catch up. Like they're not well adapt when the supermarket's cost of a dozen eggs went from $2 to $4 and they're still selling it at $5. They don't adjust fast enough. The small SMBs do not adjust fast enough. So we've also seen, I just quoted this the other day on NPR. I said, look, from a few years ago, the merchant sentiment and mentality was, how do I grow my business? And in the last 2 years, it's more like, how do I stay afloat? So we do see a lot of that. But again, it is cyclical over 8-9 years. I've seen it go up and down. The only industries right now that I would certainly say that have been affected and have some issues, definitely anybody dealing with construction, commercial real estate, those providers, those contractors are really having a hard time. Truckers, poor guys, they're always in trouble because I've seen just a lot of issues in the trucking industry. And last is, the goods. The services guys are doing great. But the goods, the manufacturers, the cost of product, they're also having definitely tighter margins now, less profits, and more concern in those phases. So we do look at all of that, right?
And I would imagine that if you're in the goods industry, given the last couple of years, it's probably been a lot of bouncing around between your cost inflates. You may not be able to adjust that fast. Your cost declines. I mean, the parts are moving so fast. You might not be very easy to figure out profit margin on a month-over-month basis, or at least for a while, it probably wasn't, right?
Yeah. I mean, and think about our typical entrepreneur, an SMB entrepreneur that might have 300 employees, but how many of them are really well adapted to analyze pricing and inflation and then again, how do you as a supermarket owner, for example, how do you go raising prices for a dozen of eggs from $5.99 to $9.99? Your customers go crazy and we're dealing with people that are dealing with people, and it's just a different mindset, right? Than when you're dealing with, we have merchants from Silicon Valley. We have internet, software, IT. We have all these online sellers. It's different mentalities, right? And we know how to adjust that. Like we can underwrite a deal way better because look, we've processed over 200,000 submissions. We worked with over 200,000 to date. And so we've seen a lot of this. Unfortunately, bankers don't see this. They don't have this engaging conversation like we do. We can help bankers and banks. We do that often. We can give them a lot of insight that they're missing because they're algo driven. So the credit unions, the local banks, they're looking for these relationships. Certainly, the big 20 are not as much, but the smaller banks and the local banks, they look for these type of relationships and guidance. They're limited on what they can do, how they can do it, and how much resources they have. And I think we're better adapt for that than they are.
Okay. Well, Alex, that's every question I had. Did we miss anything from what we talked about in our prep session?
Yeah.
Anything I missed in concept, or is there anything else that we talked about earlier that we should cover here?
No, I think we've pretty much covered it pretty well. Thank you.
No, and I appreciate you spending time with me. It's a fascinating model, and I think, if you're going to step outside your shoes as a banker, or at least, try to get a better understanding how the world outside of small business administration loans work, or any other funding, right? I think you got to understand the alternative models out there, and I think this is a great one.
For banks, there's an alternative to helping your customers. And for merchants, there's going to be new products. There's going to be new access to capital outside of traditional banks. And banks need to adapt to that, right? I think that's key. Being able to adapt to the changing financial instruments that are becoming more and more available, I think is key to the future and to success.
Yeah, and again, I like the concept of a partnership to some degree, right? If they can't bank them, then why not send them somewhere that can help them? Because I'm guessing they still want the relationship, the bank relationship, whether it be as an account holder or the 9 other ways you might bank them, right?
Look,
might not all be commercial lending.
We trust our bank because we leave our money there, right? I'm a little older, but we trust our banks to leave the money there. And we've always looked up to bankers, and bankers should be heroes, right? They're supposed to be there to help us, right? When we need it, right? It's funny, when you don't need it, you get offered everything, right? Oh, I've got all this credit available, but I don't need it. But it's you got to help those that really need it. And I want to inspire bankers to be heroes to their customers again.
That's great. Well, thank you, Alex from Unkite. We appreciate you spending time with us, and we'll look forward to you in the future. I like your insight.
Thank you, Charlie. Have a great day.
Okay, so that's it for Bank Talk. Thank you for listening today. Have a good day and keep on learning.
Thank you for listening to the Bank Talk podcast, brought to you by Remedy Consulting. To reach out to Alex at FundKite, go to fundkite.com. Fundkite.com. If you like what you hear, please rate, review, and share our work with others. Thanks again, and we'll see you in the next episode.